April 13th. The date Wall Street has circled in blood red. Goldman Sachs just dropped a $2.5 billion bomb on the market. But here is the trap nobody is seeing. The real truth, no hype, data-driven. We are 72 hours away from the most anticipated earnings report of 2026. The Goldman Sachs Group, ticker GS, reports first quarter earnings before the market opens on Monday. The market is pricing in perfection. Analysts are calling for an EPS of $16.35 to $16.48. That is a 16% increase year over year. Revenue is projected to hit $17 billion, up 13%. On the surface, it looks like the king of Wall Street is back. Trading volumes are up. M&A is hot. But if you think this is a straight line up, you are walking into a psychological trap. Today we are breaking down the fear, the risks, the opportunity, the numbers, and the trap, the retail investor psychology. Stay tuned until the end for the 3 secrets Wall Street doesn't want you to know. Let's address the fear first, because if you ignore the risks, you deserve to lose money. Risk number 1. The regulatory hammer. The Basel III endgame isn't just a buzzword. These capital requirements are fully integrated now. Goldman has to hold more cash against their trading books. We are seeing a massive rotation away from risky corporate consolidation. Risk number 2. The M&A sputter. Everyone is talking about the deal-making renaissance. But look closer. The M&A engine is stalling. Mid-market deals are frozen. Strategic transformations are being delayed because of interest rate volatility. While IPOs are hot, the big money, the mergers, is cold. Risk number 3. Tech spending. Goldman is investing billions into One Goldman Sachs 3.0 and AI. Technology spending is eating into margins. They released $2.5 billion in reserves, which is great for this quarter. But it masks the fact that operational costs are rising faster than expected. This is the fear. The market hates uncertainty. And right now there is plenty of it. But let's be clear. Fear creates opportunity. And the opportunity here is massive. The trading boom. Goldman is a trading machine. With geopolitical tensions causing what folks are calling geopolitical stagflation risks, volatility is definitely back. And guess who makes money when the lines go crazy? Goldman's FICC, or Fixed Income Desk, is projected to pull in over $5 billion. Equities trading is up nearly 20%. The IPO window? The first quarter of 2026 saw over 120 IPOs. That's the most active start since 2021. Goldman is the banker to the so-called innovation supercycle. AI companies, aerospace firms, they're all going public. And those underwriting fees? Pure profit. Remember the Apple Card? It was a disaster for Goldman. They're offloading $20 billion in balances to JPMorgan. They're taking a $1 billion hit to get rid of it, but honestly, that's a good write-off. It proves CEO David Solomon is finally listening to investors. Get back to basics. Historically, Goldman has beaten EPS estimates for 8 consecutive quarters. The average surprise is 14%. The trend is your friend until the trend ends. And now, the trap. This is where the psychology comes in. The trap of consensus. Right now, 17 out of 26 analysts rate GS a hold or worse. The average price target is only $934. That is barely a 3% premium from current levels. Wall Street is cautious. But retail traders? They are piling in because the stock went up 94% last year. The trap of the proxy, here is where it gets juicy. Goldman Sachs is holding its 2026 annual meeting on April 29th in Salt Lake City. Why do you care? Because in the proxy statement, the DEF 14A, filed with the SEC, they talk about executive succession planning and shareholder value creation. History shows that when Goldman moves its meeting to a low-key location like Utah, away from the New York City media glare, they are usually preparing for either a massive restructuring or a big internal change. The trap is thinking this is just about the earnings number. It's not. It's about what happens after the meeting. They are sitting on a massive backlog of deals. They are waiting for the all-clear signal. If the earnings call on April 13th sounds too optimistic, be careful. That is the sell the news event. Here are the 3 secrets the algorithms don't want you to connect. Secret number 1, the volatility harvest. Goldman doesn't care if the market goes up or down. They care if it moves. The current fear in the banking sector, regional banks wobbling, is the best thing for Goldman. They are the safe haven for institutional money fleeing smaller banks. Opportunity. Secret number 2, the Basel ceiling. The trap is real because of capital rules. Goldman cannot grow their balance sheet infinitely anymore. To grow EPS, they must cut costs or buy back stock. They are buying back stock hand over fist. That is the only reason EPS is hitting $16. Support the stock price, not the economy. Secret number 3, the fear sale. The $2.5 billion reserve release? That isn't just extra cash. That is them saying, we were scared of a crash in 2025 and it didn't happen, so here is your money back. If they are releasing reserves, it means Goldman Sachs sees no recession in 2026. So, what is the trade? If the report on April 13th shows $16.48 EPS and strong trading revenue, the stock will gap up. But watch the $950 level. If it fails to break $950, the trap is sprung. Institutions will sell the news. The verdict: Goldman Sachs is a well-oiled machine. The fear is real. Regulations. The opportunity is real. IPO boom. But the trap is only for the greedy. Don't trade the headline. Trade the reaction. If you want to see the exact price levels where I am buying GS, check the pinned comment below. Subscribe for the earnings breakdown on Monday morning. Stay sharp. I'll see you on the other side of the print. Watch our JPMorgan versus Goldman Sachs deep dive.